All right. Hello, welcome. Glad you can make it. Today, what I want to do during this webinar is I want to represent the information that we had from our first in-person event. It was a couple of weeks ago out at Richland Country Club. We had a full room. There's a lot of appetite for this information, a lot of great idea sharing and questions came from that. So, and I had people ask if I could present this live via webinar. So that's what we're going to do today. I'm going to go back through some of those slides. Also during this session, at the bottom of your screen, you should see a Q&A that should be active. Feel free to type in your question. And at the very end, and it won't take too long, I'll probably spend 20 to 30 minutes tops going through the slides, maybe not even that long. And then I'll get to your questions at the end and I'll go through each of the questions. And if I see it during the middle of the presentation, I may just answer it live. So feel free to use that. And yeah, let me go ahead and share my screen. All right. 1 second. All right. Well, first I want to say this is actually, it had been, so I did this a couple of weeks ago. The last time I did an in-person event was March the 3rd of 2020. And this is actually a picture from that event. And that's the same room we used the other day. 18 months. I mean, that, it was the energy I got from being in front of clients again. I can't even, I can't express how much that was needed and how much I've missed doing that. I had a chance about a month ago in Chicago at the Raymond James Top Advisor Conference to speak in front of a group of advisors, but it's nowhere near the same speaking to other peers as it is your clients. So I really enjoyed doing that. Thank you to those of you who came. We even used this picture. We made a joke. I went through and pointed out a couple of people that were there a couple of weeks ago, and one guy had the same shirt on. And then I realized I had the exact same outfit on as well. So the joke was on me. So sorry you had to miss that joke. It was a crowd hit. All right. And then my team was there. Most of my team was there a couple of weeks ago. Obviously, we're doing a webinar today, so everybody's not on it. But I went through a couple of quick updates about our team, and I wanted to share some of those with you today. Carson. So there's Carson. Many of you know Carson. Carson, during COVID, he was able to, him and his wife celebrated their second daughter back in March. So that was exciting. Miles, hopefully you can see my little pointer. Miles was married last October. So that was a pretty big event during COVID. And a lot of you know Julie's son, Hugo, he turned 2 years old, and he's probably my size already. He is a big kid. But we went through all of that. So I'm very proud of my team. Come to the office, see us. We'd love to see you if we haven't already. And then I went through some other updates as far as our office and things like that. We expanded our office during COVID. We used that time to look at our practice. And I really went, had a lot of introspective saying, what do I want this practice to look like over the next 3 to 5 years? And what I've learned being a leader over time is your number one asset is your people, and hiring great people is the best thing that you can do. And so I've been very fortunate taking my time over the last 5 years to hire this great team. And so we bought the office next door. We expanded our office, added another conference room, added some new offices, looking ahead, thinking that we wanted to hire maybe 1 or 2 more people over the next year. We added a wellness room because that's something we've really focused on, is just overall wellness for our clients and also our team, and put in a little workout facility and a sauna, and just trying to make this atmosphere as comfortable as possible, since we're here like family every day. And so that's something we did. And again, I look at our practice, and we're not a volume shop. And so what I was telling clients at Richland was, our goal is to add about 10 to 12 new clients a year. That's it. And it's all word of mouth from our existing clients, from people like you. And so I want to hire very well, pay very well, keep people on my team for a long time, and then bring on 10 to 12 new clients a year that are likable, coachable, and disciplined, and that we want to do life with. And so I'm at a place in my career after 20 years of doing this that I can thankfully say I'm able to do that, and kind of, if I build it, they will come. And I've started noticing that's been happening. So thanks for being a part of that. And then also during COVID, me personally, These are some pictures of me and my father. So a lot of you, if you are clients or if you spent time with me and I've been able to share this with you, you know that my mom's been very sick, unfortunately with Alzheimer's. And so I've utilized this time over the last couple of years and during COVID to spend a lot of time with my father. And we, during this year, this is us at the beach. We took 2 father-son trips to the beach, and we had never done one of those ever. So this was, let alone to do one, but to pull off 2 was really, really special. And so I wrote up here on this slide, time equals love. That's something that my dad taught me when I was a kid. He would always say, how do you spell love? Or how do you spell love? And then he would spell it time, T-I-M-E. And that really resonates now. Basically, call your parents, spend time with your parents, spend time with the people that you love. That's how you show you love somebody, you know, not gifts or anything else. And so that was something that I got to do. And we went around the room and a lot of people there shared other experiences and, you know, emotional stories from their families, good and bad things they experienced during COVID. So I appreciate you sharing that. Hard to do that on a webinar, but I wanted to share some of that nonetheless with you today. During this time, I really, you know, looked at kind of the bigger picture and said, we've been so fortunate here at David Adams Wealth Group and growing our practice. You know, what is something I can do outside of just me and outside of just a for-profit venture? And so I looked for, you know, put some feelers out to join a nonprofit. And this group, In Slavery, which is a nonprofit aimed at stopping sex trafficking here in Middle Tennessee. You know, I had no idea that even went on that close, you know, to our backyards. And so I learned a lot about this. Since then, I've been asked to be the chair of the Capital Campaign Committee and spending time doing that, where we're going to, you know, build a house and a bunch of safe houses for these victims. And we actually received the first ever $3 million grant from the state of Tennessee to acquire the land. And now we've acquired the land and we're starting the fundraisers and different things to actually develop the property. So very excited, very exciting. You've probably seen some of my social media posts. Some of you have even donated and followed this on social media. So I really appreciate it. Thank you so much. All right. So what has happened since we last met back in March of 2020? Not a lot, right? There's this global pandemic apparently going around. On a serious note, it's been, you know, people have had their worst years, and I've met with several of those, and people have had their best years financially. Some have lost people that were close to them due to COVID. So it's been an emotional roller coaster, to say the least. But that's really been, I think, the biggest thing over the last 18 months that we've all gone through together. We also went through, I mean, it seems like it's been a while now, but the most contentious election, you know, I say ever. I've talked to clients much older than me, and they've kind of validated that they've never seen anything like this in their 60, 70, 80, 90 years on this planet. Definitely a contentious election, a very divisive social landscape. I think we all have felt that, you know, and talking with friends, people disagreeing, and friendships, unfortunately, tainted because of different views and stuff. That's very sad, but that's happening. That's how bad things have gotten. $5 trillion of government spending. You know, that is, I read a stat, that is like 25 to 30% of the dollars ever printed in the United States history have happened in the last 18 months. Let that sink in. That is a lot of spending, and there's a lot going on. So that's the money we spent for the COVID stimulus. We also have the infrastructure bill on the table. We have another $3.5 trillion being presented in Congress right now that I'm going to talk about. So lots of things that could impact the market long term. But at the same time, record corporate profits. I mean, blows my mind. Record government spending, a global pandemic, you know, a divisive landscape, but yet many corporations are making the most money they've ever made. I've never seen economics line up this way from my studies in business school and that sort of thing. It's really mind blowing. We've seen things like with technology. I mean, gosh, commercialized space travel began just, you know, a couple of weeks ago. We saw that, if you watch that on TV. Lots of pending tax changes, some of which I'm going to talk about today, because I know that's a question I'm getting a lot, and I got a couple of weeks ago. We also, during the last, this has all happened in the last 18 months. It's insane. The fastest drop in bear market in the history of the market. So what I mean by that is not the biggest drop, but the market fell about 33% in 34 days. It's the fastest it's ever dropped. And technically, when the market falls over 20%, that's considered a bear market, and that happened. So that was the quickest bear market ever only lasted like a month. Usually bear markets are like a year and a half. And since we last met, this was like when we met, the market was actually free falling. It was in the middle of that kind of 30% fall. Market's up 30, 40, 50%, depending on which index you're looking at, just since last year. What else? I think that's plenty. So clearly a lot has changed since we last met. And so there's a lot to go over today. All right. So what I want to show you on this chart is really that this is just showing kind of administrations, Democratic in blue, Republican in red, obviously, going through each administration and showing just the growth of $10,000 in the stock market. Basically, what I'm trying to show you here is that investing based on your party being chosen and into office is a horrible financial plan and strategy. Do not do it. Think about the times that, I had people in my office when Obama won, they thought it was the end of the world and wanted to pull their money to cash. And then the same thing when Trump got in, thought it was the end of the world. And now Biden, I've heard it over and over and over again. And more so lately, I'll say, just because the elections have become more contentious and, just the parties are more disaligned than ever. But the reality is, if you look at this, look at the trend. The market continues to go up. At least it makes people fools all the time that try to time it and try to guess and try to pull out based on, well, if Trump's in, then the market's going to tank, or if Biden's in, the market's going to tank. It's not the way the market works. So please don't fall victim to that. I've seen that happen too many times in my 20 years. What I wanted to show here. So one thing I tell clients all the time in meetings is, if you're new to the stock market, think about it this way. About 3 out of 4 years, the market's up 75% of the time. And about 1 out of 4 years, you have a down year in the market. Okay. And about 1 every 10 to 20 years, you have a really, really bad year. Think like 2008 or around 9/11, right? So this chart, I know there's a lot going on here, but this just shows what the market finished up. These are all the up years. You can see about 3 out of 4 times. Yeah, 31 out of 41 up. And the other 10 or so were down years. And there's your normal down years. There's a big 2008 market down 38%. You can see 2002 and 3 after 9/11 market was down quite a bit. Those are kind of the anomalies. But generally speaking, you can see a trend. But what's interesting is even during these average up years, all these years that the market's up, you see this little red mark. This is showing that during that year, so like if you look here, whatever, 2000 and maybe 10, the market was up 13%. But at one point during the year, it was down 16%. So the takeaway is during the average year that the market finishes up, it's at least down 13 or 14% at some point during the year. So, and this year was, last year, 2020 was one of the most extremes. You can see right here, the market was down 34%, as I mentioned earlier, but it finished up 16. So in March, you're watching your account fall 34%, freaking out. Hopefully you weren't, but let's just say in theory. And yet, if you had to just not looked at it and just ignored TV, December, you would have got your statement and you would have been up 16%. Hello, Carson.
Hey, and I'll add something to that as well. Being a good investor in the stock market is all about having the right perspective on what's to come in the stock market, just like what we roll with. And the reason why this chart matters is kind of a cool stat. We haven't had more than a 5% pullback in the market, I think, since September or October of last year. So that is extremely, that's not ordinary for something like that to happen. So year to date, we haven't had one of these normal, on average, 14% pullbacks, because a lot of times coming out of COVID, we have this perspective, oh, I'll just wait until the market drops again and then I'll put some cash to work. So the right perspective is knowing that over the course of a year, yes, you're going to have a pullback, but over the long term, markets always, not always, is generally 3 out of 4 years, like David said, going to be up. But know that throughout the year, you're going to have some sort of pullback greater than 10%. If you don't have cash to put to work, just mentally be prepared and help yourself expect for something like that to happen and swallow it and move on and know that, remind yourself 3 out of 4 years, the market's going to be up. So, yeah.
And that's a good point, Carson. So expect, it's September now. We haven't had that, which is unusual, but I would not be surprised if over the next couple of months, the market falls 10 or 11%. And that may alarm some of you, but it shouldn't, because the market's going to come back as it always does. And if anything, if you've got extra money sitting in your emergency fund, or you're sitting on cash that you wanted to put in a year ago and you wish that you had it and you're kicking yourself for not putting it in the market. Now's, that over the next couple of months, that's going to be a great time to do it. So we have a lot of clients. We keep a list of clients that tell us, hey, we've got $200,000 in our bank account. We usually keep, 75 as our cushion. So put us down like when the market's down to kind of help us get that money back in the market. We have a process for doing that. So you can ask us about that offline, but I'll go to the next chart. But again, in 20 years of doing this, I've never seen anything like this, like 2020, down 34, but finished up 16. And this next chart, this gets even more crazy. All I'm showing here in the blue is I'm showing a 60-40 portfolio. So the other portfolio was assuming you were 100% invested in stock. I don't have a single client. I don't think I have a single client that's 100% stocks. I always want to have some cushion in there, some bonds, right? So this shows more like a 60-40, 60% stock, 40% bond portfolio. That's more indicative of maybe one of my retired clients. And it shows the same story, just not as exaggerated. So like in 2020, their account was down 21%, not 34, but they still finished up 14%. So it was just a wild year. So basically, and going back through all these years, we track this to see, you're going to have lower lows, but you're not going to get as bigger returns on the upside. And that's all about figuring out your risk tolerance. Should you be 60-40, 70-30, 80-20? And we talk to all of our clients one-on-one about that. So what I want to show here, this is interesting. Just, this is why we don't market time. What this is showing is that if you invested over the last 20 years, you put in $10,000, it's now worth $42,000 in the S&P, like in the S&P 500 index, right? You average 7.4%. So good return, right? If you just took the 20 best days, if you just try to time the market and you happen to miss just 20 of the best days over 20 years, look at your return. It's almost zero. You literally missed 20 days and you went from 7% a year to zero. And you can see if you missed 30 days, you actually went negative. 60 days, you went way negative. Again, just showing that missing just a couple of the best days is catastrophic to a plan. And on top of that, usually if you miss, if people pull money out, like after a really bad day in the market, like they get freaked out and the market falls 1,000 points and they pull their money out of their account, it's usually within the next couple of days that the best days come. So it's a really tricky game to get involved in. Like, oh, I'm getting scared. Let me pull my money to cash. The next day it shoots back up 1,500. Now you missed out. Very hard. And this is how people end up getting, the average investor ends up getting 1 or 2% return a year, whereas somebody working with a professional hopefully is getting returns that look more like this. Let's go to the next slide. I don't think it's a surprise to anybody that, your returns at the bank and on cash are essentially zero. I remember, you can look back here. This is showing if you put 100,000 in a savings account back in 2006, you got $4,500 a year on that, 4.5%. That's crazy. I remember like Raymond James money market clients were getting, 3, 4, 4.5%, whatever. And now $80 is the average, $80 on $100,000 sitting in the bank. That is not very good, if that's not obvious. And this is why we think stocks are going to continue to do well. Even if you're not, yes, there's a lot of government spending. There's a lot that concerns me going on. Absolutely. But again, the stock market has a mind of its own. Where else are you going to put your money? How else are you going to beat inflation? The cost of pork and chicken and bread and everything and gas is going through the roof, 4, 5, 6%. If you're making 0.8%, point nothing at the bank, how are you're actually losing money. So that's important to see. This shows it kind of in a different way, that this is showing the return on stocks and then all the way down, the average return on stocks over the last 10 years is near 13% from 2011 to 2020. And we've had a pretty good run in the market. Inflation's averaged 3%. Okay. So you can see if you invested your money, you're averaging 13% with us or whoever in the stock market. After inflation, it's more like 10%. That's like your true growth of your dollar is 10% because the cost of goods went up 3%. But look what happens if you are in cash. If you're only averaging 0.6%, which is probably a fair number right now, and you have 3% inflation, every year you're losing 2.5%. of your money by keeping it safe, if you will. And even with bonds, I mean, we're barely making anything on bonds, which is why, clients will ask me, well, David, why would we even own bonds? And the reason is because we don't want to have all your money in stocks, because most of our clients don't have that risk tolerance. Or if the market goes down, stays down for a couple of years, I want to have some dry powder, some bonds that I can go and pull from to give them income and not have to sell stocks while they're down. And I'd rather do that in bonds than sitting in cash, where I at least have a fighting chance of getting 2-3%, something like that. Oops. Let's see. Okay, I skipped this one. This is interesting. This is kind of showing the same thing, but in a different way. This is showing that if you have $100,000, this is always a tricky chart. Basically, I like to look at it this way. Is if you had $100,000 today, in 20 years, you're going to need $338,000 to have the equivalent to be able to buy the same amount of goods that $100,000 will buy today with 5% inflation. So what does that tell us? That's pretty scary. That's just, during your lifetime, if you're 40 years old, by the time you're 60, 65, $338,000 is going to be the same as $100,000 today. So you have to grow your money, and you have to do better than 3 or 4 or 5% with inflation. And the only way you're going to do that is likely with stocks. And
I'll add, David, to the erosion of purchasing power on the left side. Typically, we talk about returns compounding, but for the better. Invest in the S&P 500. It has an annualized rate of return, sometimes depending on what period, sometimes around 8, 9, 10%. So we always talk about that compound interest. For this, it's in the reverse when it comes to inflation. So if we're having 3% annualized inflation and you compound that at a negative rate, that's what it's saying. In 25 years at a 3% annualized inflation, 100 grand ends up just being $47,000 because it's working against you, not for you.
Yeah, absolutely. All right, this slide, this is just not a lot to show here. This is just, this is a 120-year slide just showing the market and all the kind of ups and downs in the market and what we've been through. And you can see there's, it's going through like bull markets and bear markets, like the tech boom. And then there's COVID, the drop there. There's the 2008 crisis, just showing a kind of a good picture over 120 years when you start to expand things, what the true growth of a dollar looks like. But this was interesting. This is going back to, I mentioned this being the shortest recession. This shows in blue, this shows all the bull markets. And a bull market is when the market, rises over 20% over a period of time, and a bear market's when it falls 20%. And you can see usually the bull markets last a lot longer. On average, they last 4.4 years. About 4 to 5 years, and the average bear market lasts a little under a year, right? But look at this. This is the one last year. It was technically recorded as a recession because the market fell 33.9%. It lasted 1.1 months. That is the shortest recession in the history of the stock market. There's the one in 2008. It lasted a little over a year, fell about 50%. I'm sure everybody remembers that. So that's just fascinating. We've never seen that. And it shows that just information and trading and things and news and everything is traveling and happening so much faster now that you can get a year's worth of market volatility can happen in a matter of a few weeks. So if you get caught panicking and trading during that, you can really get beat up. Because who would have thought, if you had told me, 18 months ago that our clients' accounts would be up double digits and the stock market would be up double digits, I would have thought you were crazy. I was preparing with my team. We were doing our risk management of our practice and saying, hey, things are going to get bumpy. The market may finish down 20%. I don't think it's going to be down 50%, but it may be down 20%. Let's make sure, we're prepared. Let's make sure we're talking to clients about this and we're tweaking things and yada, yada. And we were shocked on the upside. And so that just, again, we've been doing this, or I've been doing this 20 years, and I've talked to advisors that have been doing it 40 years, and none of them have seen anything like this. So that is why we adopt a plan and stick to it. Okay, taxes. So this is a big one. Here's what I do know. And again, I'm a CPA. Carson on my team is also a CPA. So we stay very much in touch on the tax side of the business, even though we don't physically do taxes anymore. It's very important to an investment strategy because like inflation and taxes can erode the growth of your money if you're not smart with taxes. We know that taxes are going up. We know that, and these are not political statements. I'm just going through what happened. Trump lowered taxes during his administration. The highest tax bracket right now, and that's not on here, is 37.6% or 37%. It was close to 40% when Obama was in office. We think it is almost definite that Biden is going to increase that back from 37 to 40% for those earning over 400 or whatever. Expect that. This is the biggest one that I've seen. So long-term capital gains. This is any asset that you hold more than a year. If you're one of our musician clients and you sell a catalog, if you sell a piece of real estate, a rental property, you sell your business. This is a big one. Right now it's 20%. It's 23.8 because there's 3.8% for kind of like a Medicare tax. But essentially most of us know long-term capital gains, as we say, it's 20% right now. Biden wants that to go up for those making over 400 or maybe $1 million. It just depends, to double up to 40%, which would mean it'd be over 43%. That would be, I do not think that's going to happen. My team doesn't think it's going to happen. The team of economists on our investment committee do not think that's going to happen. I think that would be catastrophic to the stock market. And I think that's just a place to start negotiations. Any good negotiations, you say it's 20, we want 40, you settle on 30. We think, expect, who knows, but capital gains end up in that 24, 26, 28% range for higher income earners. I do think that's coming. I personally don't think that will break the stock market. If it goes to 26, I don't think that's good for the market, but I think taxes have to go up to cover some of the spending. And I think that because we're expecting, or we're concerned about the worst, if we get anything in the mid 20s, the market will be able to absorb that. So more than likely that's what will happen. Let's see, the other big thing is, well, I'd say the biggest is going to be the step up in basis. So this is basically says, if you own a stock or a house, let's say, mom and dad bought a house for $200,000 and now it's worth $1 million. If they pass away right now and you inherit it, you inherit that $1 million, you get to step up your cost basis to $1 million. And so you only pay taxes on anything it grows to over $1 million. Biden's proposal was to take that away. So that would mean if you inherited that $1 million house, you would now have an $800,000 gain. This would be very huge and affect a lot of people. I do not think this is going to happen. It could, do not think it's going to happen. So our team, like kind of the over-unders and all that, like the Vegas odds, we think that 37% ordinary tax rate is going to 40. We think capital gains is going up from 20 to 20 something. And the corporate tax rate, was at 35. Trump lowered it to 21. Biden wants it to go to 28. There are several moderate Democrat senators that, like Joe Manchin, that say no way. They're saying maybe 24 to 25. So expect some compromise there. And I think that's what you're going to end up with, is something around there. We'll know more of that over the next few months. But we don't think it's going to be as bad as proposed. But we do know that taxes are going to go up, and they're going to have to go up. And I don't think taxes are going to be as low as they are now for, I can't say forever, but for the foreseeable future. So we're planning for that on our team. We're coming up with strategies. If capital gains rates goes through the roof, we're going to get with all of our clients that make over $1 million a year. And we already have a plan that we've been building that's pretty interesting to help with that. So stay tuned on that. I know that we are. And so basically what's next? So here's just a few thoughts. The infrastructure bill has currently been going through the House and the Senate. It's more than likely going to get passed, probably with a $1 trillion price tag, give or take. We know that's coming. That started with Biden had that over $2 trillion. They've got that down to around $1 trillion. I think both parties agree we need to do some infrastructure spending. The argument is what's all in the bill, the stuff that doesn't have to do with infrastructure. They're arguing over that. So we're going to see that kind of hit the tab this year, if you will. Plus, there's another 3.5 trillion on the table. This is very, there's a lot of disagreement between the parties on this. And some of the more moderate Democrats are going to bring that price tag down, I believe. There's a lot of stuff in this spending bill. This is more that 10-year plan that is very, very partisan. And it's very much, it's just, yeah, there's a lot of concern on both sides about this, but I see us getting an 800 billion to $1 trillion infrastructure bill, and maybe a couple trillion of this additional spending. And so that's why inflation, we're afraid, is going to kind of run away from us, and we have to be prepared, and you have to have a good investment plan. again, I mentioned the moderate Democrats. Are they going to get on board with this? We think that they're going to not at the full price tag. Same thing with taxes. We think there's going to be some negotiations. It's possible that there's not, but that's what we think. Most of our, these are not my personal, some of these are my personal opinions and kind of predictions, but these are really coming from our investment committee, which is made up of other advisors, a bunch of top economists at big institutions across the country. So I'm giving you kind of the consensus view, not my personal view, that there's likely not going to be another government shutdown. The team feels like there'd be so much resistance that it would be hard to pull that off and people wouldn't listen. However, we are seeing this, and we think we'll continue to see more mask mandates coming back, and they already are, and limited vaccine mandates. So probably not a government vaccine mandate, but more states and certain restaurants and entities are going to start maybe requiring that. So we're seeing some of that, and we're seeing arguments back and forth and with the schools and stuff. I mean, this is not going away anytime soon. We think that the Delta variant, that that's already priced into the stock market. We already know about that. I think what would hurt the market or be a surprise would be a new variant, and there will be other variants, but a variant that is twice as deadly or something that really causes more fear. But right now, we think the Delta variant is priced in. We think that interest rates stay low. The Fed is doing everything they can, and they've told us over and over they're going to keep rates low until at some point inflation gets out of control and rates start to go up, and that's when I think we're in a little bit of trouble. But we think in the short term, markets continue to go higher because interest rates being low is very pro-government, very pro-real estate. It keeps money moving and people buying stuff. And technology has never moved this fast, and it's never going to move this slow again. Somebody mentioned that in one of our investment committee meetings, and I like that comment, that it's crazy how fast it's going, but they don't think it's ever going to go like 5 years from now. The pace it's moving at now will be considered slow, i.e. look at space travel, right? And then we think that the housing market boom that's going on, I'm not just talking about here in Nashville, I'm talking about across the country, but I mean, I could definitely localize it here to Nashville, was caused by one shock to the system, meaning with COVID, you had like here, let's talk about locally, you had all these people from Chicago and New York and LA moving to places like Texas and Tennessee, and our housing market, prices have just gone up 10, 20, 30%, houses getting $200,000, $300,000, $400,000 over ask with no inspection, no appraisal, selling in 7-day closes. It's insane. We think that's going to level out over the next year, and that wasn't indicative of the housing market to come. And this was an interesting quote somebody sent over to me. We have a country that is spending too much time thinking about government, which means less time thinking about innovation or producing goods and services that people really want. And that's very true and very alarming at the same time. We need to get back to individuals and also just as a country and businesses thinking about innovation and not obsessing over what the government's doing and fear and that sort of thing. All right. So in summary, I gave you the answer. How do we beat inflation? We know it's coming. It's here. Stocks. We have to be invested in the market. You can't be keeping all your money in fear on the sidelines. You have to do this. Market pullback, yes, we think one is coming. We haven't had one this past year. We think it's coming, but not a specific. That doesn't mean that something's wrong or broken. It's just expected. And we think that's a buying opportunity as always. And if you don't have extra cash and you're in the market, you've got your emergency fund, you've got some money with us sitting in bonds as you're padding. If you need money, we'll spend money from bonds and cash during a market pullback and never sell stocks while they're down. So you are prepared and ready for this if you have a plan. Please tell me you heard this. Do not invest with your politics. Never a good strategy. And it's something I've had to continuously learn, and I've fought it because I've done this 20 years. We want to be able to see patterns and predict the market, but the market makes fools out of even the smartest investors. Nobody has a clue exactly what direction the market's going on. Our value add to you is in the planning and prepping you and having all of our different buckets set up. And so, yeah, led right into that. That's what we can control, is the planning and the 3 buckets. If you've read my book, The Currency of Time, or you've been a client, you know all about my 3 buckets, and I can send you a video on it. I've done all sorts of talks about this. It is the flag, kind of the cornerstone of our financial planning. You have your emergency fund, which is bucket 1, always have 3 to 6 to 12 months of expenses. in cash and any major purchases you have coming up in the next year, so that you don't have to pull money out of the stock market if we have a temporary pullback like we had with COVID during last year. People lost their job during March, or if you were a musician, you had no income, market fell 30%. You do not want to have to sell stocks while the market's down. So that's why we have a bucket one. Bucket three is long-term money. That's your IRAs, 401ks. That's retirement accounts. You get tax advantages for those, which is great. The downside is you can't touch it till you're 59 and a half, which is why we have bucket two, which is that middle bucket. It's money we don't want sitting in the bank making 0.5% in cash in bucket one. We don't want all of our money in bucket three because we can't touch it for a long time. Plus, you can only put so much money in bucket three. So that's when we have this moderate portfolio where we're trying to get, a decent rate of return, but also keep it liquid. I could talk about that for an hour. So with that being said, I'm going to do you a favor, and I was going to say be quiet, but I'm not. I'm actually going to answer questions. Let me see. No way. Carson, am I reading this right? Do we not have any questions?
No questions yet.
I'm going to give it a minute because I've never seen that happen. I just did a really good job explaining, I guess. That's what I'm going to tell myself. And there are no questions. I was 100% clear. Type
David,
in if you have a question.
David, this is Miles. I would just add too, for anybody that maybe tuned in late or wants to share this with friends or family, we're going to have a replay of this available early next week that we'll send out to everybody and have posted on our website. So if you want to share it or watch again, if you tuned in late, we'll have that for you next week.
Awesome. Thanks, Miles. I'll give it another few seconds here. If you have any questions, you can type it at the bottom of the screen. If not, always email me, call us, email us. If you're a client, you know where to find us. And if you're not and we can help you, let us know. But basically, yeah, build a good financial plan. That one that can weather storms, the short-term ups and downs, because it's not a game you want to get involved in trying to time this stuff. Make sure you're not cutting off your nose to spite your face, and you don't like what's going on in Washington. So you're staying away from investing. That is not the way to get back at politics. You're going to see some pretty big inflation over the next few years. So we need to have a plan. And so let us help if we can. With that being said, I think I'm going to go ahead and end this if nobody has any questions. So thank you for listening. Thank you for coming for that full room we had a few weeks ago. And we'll be doing more of these, probably another one here in the next couple of months. So thanks for attending. Talk to you soon.